Welcome, everybody. I can see lots of people are joining. We're going to give it a few minutes and then we'll crack on. Let's see. So maybe we'll wait till 1:05 or something like that, and then we can get started. But welcome, everyone. Thank you for joining us. As you can see, Dad, well, we're doing it slightly differently. I don't know if for people who joined the last one. Dad and I are not in the same place, but actually this might work quite well. Maybe I'll give it another minute or two and just wait for everyone to come. If you're familiar with the Zoom app, you'll see that there's a Q&A bit. So if you look at the bottom of the Zoom window, you should see the Q&A where you can submit some questions. Some of you already have, which is excellent. Thank you very much. And then you can raise hands as well, which is also useful. But what we'll do is I'll be introducing Dad, and then we'll ask some questions, 4 or 5, and then we'll answer some of your questions. And that's how we'll structure it this time. We're hoping it will stick to an hour because everyone's busy. Oh, it's Friday. So that's the plan. So we'll run until 2 o'clock. But it should be quite relaxed. If you want to ask anything, please use this opportunity. Dad is here to share his insights, answer your questions, and we can get into a bit of a conversation. That's absolutely fine. But yes, as ever, Dad and I are not the greatest with technology. We're trying and testing these things. We're hoping it will run smoothly. But bear with us if it doesn't, but hopefully it should. Practice makes progress, as my son always says. So 1 more minute and then we'll crack on. That's all right. So I don't know, most of you are familiar, but so my name's Arabella. Quentin Lumsden is my father. We've been working together now for, gosh, 3-4 years or something. So I support and manage him, manage the business side and manage him. But I'm sort of the main contact for most of our subscribers. So if you do have any issues or questions, please, you can always email me or contact me by phone. Okay, all right then. Well, let's get started. So today we are talking about explosive chart breakouts. And so Quentin, if you're ready, please tell us, what is an explosive chart breakout?
Okay, we're off.
We're off.
Hello, everybody. Delighted to welcome you to the second Lunch and Learn webinar. As you can see from looking at me, this is all about ancient accumulated wisdom about the stock market and life and all these other important things. The reason why we picked the subject as explosive chart breakouts is because they're important, but also because actually, although I've been doing the stock market for so many decades, it's ridiculous. This is a new concept, or at least the way I use it is a new concept. And it could be the alchemist's stone that turns base metal into gold. I have a feeling it could be a really exciting refinement of the Quentinvest approach. And before I talk about exactly what an explosive chart breakout is, although it's pretty much what it sounds like, I want to go back a little bit to where I'm coming from on all this. And first of all, the first thing I realized when I started investing was, which I learned from the Americans, was that there are two kinds of shares. There are growth shares, and there are dogs. And I love dogs, but no insult to dogs. But in this case, in this context, the meaning is that you don't want to get involved with dogs. And so I focused entirely on growth shares. And it made a lot of sense to me, because if a company's not getting bigger, why on earth should it become more valuable? But this led straight away to a second insight. There are two kinds of investors out there. There are value investors and there are growth share investors. And value investors was a concept made famous by a man called Benjamin Graham, to some extent by Warren Buffett. It goes back to the 30s, when nobody expected companies to grow against the background of a depression. So in order to make money in the stock market, you had to find shares that were cheap. And since nobody was interested in buying shares anyhow in that period, you could find shares that were incredibly cheap. And the holy grail was to find a share which was worth less than the cash it had in the bank. And so the value investors went rushing around looking for shares like that. And this whole approach to investing colored investing for years, for decades. But then after the Second World War, it slowly became apparent that economies were starting to grow and companies were starting to grow. And the concept of growth shares became a lot more interesting. And then the whole issue came up of how to value growth shares. And they went through so many things. They valued them on yield, and they were shares were all supposed to yield more than bonds, because bonds were safe and shares were risky. And then they realized that this didn't do justice to growth shares, particularly in an era of inflation. So they started to realize that it made sense for shares to yield less than bonds. And once shares were released from the anchor of bonds yields, they were able to start going up quite a lot. And that really was the start of the great post-war bull market. And then the next anchor that was removed was that a lot of American shares thought that they had better things to do with their money than pay dividends. They wanted to reinvest it in more growth. So you couldn't value those shares on yield at all. So then they developed this new thing called a price earnings ratio. And that was great, because that allowed valuations to stretch even more. And of course, people didn't know, they were operating in unknown territory, but slowly but surely the concept came up that a good growth share could be worth sort of 20 times earnings. And that was great, because it was particularly great because in those early days when accountants weren't very much on the ball, the opportunity to manipulate your earnings was amazing. And so anyhow, but you did get lots of exciting growth shares. And then we had the era of conglomerates, when companies realized that you could have a share which was on 20 times earnings, and you could buy another business which was on 5 times earnings. And with a little bit of luck, with a bit of passage of time, those earnings would be valued on 20 times earnings. So in the 80s, the great shares were companies like BTR and Hanson Trust, these conglomerates that were buying cheap earnings and then getting them valued at a higher multiple. And that was the most fantastic license to print money. And that went on for quite a long time. And when the 80s boom ended, a lot of people, me included, thought, God, that's been such an amazing boom. We're never going to see a bull market like that again. Well, of course, we were completely wrong, because in the 90s, and really starting in the late 80s, the technology boom started to get going. And as we're increasingly realizing, this is the boom to end all booms. This is absolutely unbelievable. Forget the Renaissance, forget the Industrial Revolution, forget hunter-gatherers starting to live in towns and cities and farming. This is the one that is really going to change everything. And we may still be, I mean, it's hard for the human imagination to grasp it, but we may still be in the foothills of this incredible boom. And of course, the other thing that's happened is that the whole approach to investing has changed dramatically. It's now easy to get how much leverage you like. You can literally on your screen, you can be in and out of a share in seconds. The cost of doing this is very, very low. You don't even have to pay stamp duty with derivatives, and you can invest abroad. You couldn't do that until Maggie Thatcher arrived on the scene. Pre-Maggie Thatcher, you couldn't really buy American shares. She loosened all that up, and now you can. And that has been my long-term advice. There's one amazing stock market in the world which has shares for everything you could think of, and their shares are in most cases better than any other versions, and that is America. Whatever sector you want to invest in, the Americans have got an amazing share for it. And also the Americans are companies, the managements are very well trained. They know that their job is not to go to the golf club and chat to each other and then go off for a round of golf and then laugh about how big their expense accounts were. In America, the managements go to work dressed in jeans and a t-shirt, and they are pursuing growth, and they know they have to deliver it, and that is their job. That's why they're on the planet. And so it is staggering how many wonderful growth shares there are in America. So my number one advice to people is build a portfolio composed virtually entirely of American shares, great American growth shares. And of course, growth shares, because as we decided at the beginning, there's no point in investing in anything else. There are lots of other quite good businesses. You know, there's mining businesses, there's oil businesses. The problem with them, though, is that it's hard for them to deliver growth. They're more like farmers, at the mercy of wheat prices and commodity prices. And this is a world so unpredictable that I don't like it. I avoid I used to get involved with them, but I don't. I've long ago given up. You can show me an oil show with the greatest chart on earth and I won't touch it, because I just don't know what's going to happen, particularly if they're looking for oil and haven't even found it yet. So we come back to American shares, American growth shares as being the place to be. Now, then the next question is, how do you decide which ones to buy?
Yeah, because I think, Daddy, just one sec.
Yeah.
This is going to be the issue that we have, because everyone
I'm not answering the question.
My father can talk and talk and talk. No.
Okay, you want me to get faster? Okay, so let me speed up. So now we've decided what we want to buy, American growth shares, and we want to know which ones to buy. So there are two techniques for doing this. You can use fundamentals or you can use charts. I use a blend of those two things. Increasingly, what I have realized is that actually what seems to be the obvious bit is the chart, and what seems to be the hard bit is the fundamentals. I've increasingly realized the whole thing is obvious. Good charts, it's obvious what's a good chart, and it's obvious what a good fundamentals. You can give me any share in the world, give me five, particularly with the levels of information available on the internet now. Let me look on the internet, let me find out what they do, Let me read the latest quarterly report with the analysts. Let me flip through their annual report. And in 10 minutes, I can tell you, wow, yeah, this is my kind of share. This is 3G. This is exciting. This is a business that I would like to own shares in, own a bit of, or forget it. And I mean, actually, since I only start by looking at shares that look as though they could be exciting, even if there are 100,000 shares in the world, there's only about 3,000 in America that I'm interested in, and a big chunk of those I will immediately write off. So we're getting down to quite a small number of shares straight away, but certainly enough to build a 100-share portfolio very easily, no problem there at all. But now I have come up with a concept which has always been rolling around, but it just suddenly hit me the other day. This is what I need to do. This is what I need to spend part of my day doing. And it is looking for explosive chart breakouts. So what do I mean by an explosive chart breakout? Well, it's very simple. I start with a big move. So a share making a big move, because if a share is making a big move, there will normally be a reason for that. And it will normally be related to some piece of news, some event in the lifetime of that company. And so then I do three things, really. I look at the explosive chart breakout in the context of the chart. I look at the piece of news in the context of the business, and I look at all the characteristics of the business to see if it's 3G, because if it's not 3G, I'm not going to be bothered with it. That rules it out straight away. And so I started doing this, and then it suddenly occurred to me, which was the really blinding revelation, that maybe every single great performing share starts with an explosive chart breakout. And I started to go back and look. It's a bit hard to look way back in time, because I haven't found a way. I need to find a way, because what I really want to do is look at charts with what I call breakout gaps. That a chart that goes up so much. I'll give you an example in a moment. It goes up so much that there's a whole there's a gap where there are no prices at all. And so I started to go back in time and look at shares and see if they started with breakout gaps. And I haven't looked at many so far, but all the ones I've looked at, they did. There was an incredible breakout gap. There was a moment in the life of that share, early in the life of that share's rise, when the shares leapt by 20 or 30%. And one example which I looked at, which is in my notes, was Microsoft. Microsoft is one of the greatest performing shares of all time. And they floated in 1986, and adjusted for scrip issues, they floated at around 10 cents. And amazingly, if you look at a long-term chart of Microsoft, it looks as though they just floated and just went straight up to the moon. But actually, after they floated for 7 months, they didn't do anything. They went between 10 cents and 7 cents and just bobbed up and down for 7 months. And then something, I haven't found out what, but I imagine it was a really stunning quarterly report showing tripled sales or something. But suddenly, in the space of a week, they went from 9.5 cents to 12.25 cents. It doesn't sound very much in those terms, but actually it's a 30% move. And if you had bought them then at 12.25 cents, several months later, they were 44 cents. And whoa, this is amazing. I have quadrupled, more than quadrupled my money in several months. So you might have thought, I'll take that. Well, if you did, Christ, you'd be regretting it now, because they're now $429. And in the first instance, they went pretty well straight up to $60. So this is why I'm very against taking profits and all that, because you never know when you've got this fantastic winner. But it started with an explosive chart breakout. Now, let's give you a very recent one. Last year, NVIDIA reported its Q1 2024 results for the year ending January 2024. And what was amazing about it was not so much the results. The results were good, but it was the forecast for the second quarter. People were expecting sales of about $7 billion, and they said their sales were going to be $11 billion. And the shares exploded. They were around $300 when they made the announcement, and they went straight to nearly $400 with very little trading on the way, just there. And they then pulled back to $373. So you could have bought them under $400, and yesterday they traded over $1,000 and produced results which are actually as amazing as anything. I mean, they're still producing these absolutely amazing results. And the reason why was because with that explosive chart breakout, there was an incredible something new happening. And the incredible something new happening was that it turns out that NVIDIA was at the heart of the generative artificial intelligence revolution, which many, many people think is going to be absolute game-changing development for the world. And so it was a huge development. It wasn't just, wow, that's an amazingly good set of revenue figures that they're forecasting. It was what that revenue forecast told you about what was happening in the world and NVIDIA's place in that process. And so that was incredibly exciting. Now, my concept then was, if all great moves start with explosive chart breakouts, how about coming at this from the other direction? How about looking every day for explosive chart breakouts? And when I find them, then I go and look at the company and see if it's 3G. I look at what is going on. I do my usual thing with the company of looking at the fundamentals, looking at the management, looking at the chart. And what I am finding is that most days in the stock market, there is one share, maybe two shares, that are behaving in this explosive way. And what I then do is I add them to a list. I add them to the list with the price at which I find them, and the updating of the price, the latest price. So I am building a list of the shares which I believe are going to lead the bull market in America. And some of them will be companies that I already know a lot about, like NVIDIA.
And Danny,
some of them will be completely new. Okay, stop
do
there.
you think,
so that's an explosive chart breakout. That's what it is. And if you want to think of it in percentage terms, it's about a 10% move. 10% plus move is my broad rule of thumb for what constitutes an explosive chart breakout.
That breakaway gap. Brilliant. And then do you think there are criteria that you to identify? Well, I thought I'd skip along to only because it's nearly 1:30.
Oh, really? Because the
So,
portfolio thing is quite important.
okay, well, if you want to, okay, talk about that, and then
I'll
we
try and talk
can,
about that very quickly. Okay, so
okay,
now let's think about this. How do you use this information to build a portfolio? Well, it's pretty obvious, really. And it's in fact what I have begun to do. I have started, and I have to say, people who've been with me for a while will know that this is actually just a reworking of what Quentinvest originally started to do. Quentinvest was originally designed to help people build a portfolio, a large portfolio of exciting growth shares. And my theory was that this would do extremely well. And yeah, I think it would. And but you need to maintain it. Now, the new element in this is that I basically now, in my own case, I put two kinds of shares into my portfolio. One is shares with explosive chart breakouts, which meet all the other criteria that I'm looking for. And the other is when I find them, which I do, I'm sort of looking for them as well all the time, is great growth shares with great charts. And to my amazement, there are many new names. This is producing many new names. So my portfolio now consists of, I mean, you know, some of the only names I've got from the past are named in my portfolio are names like Nvidia and Microsoft and Google, Apple, Alphabet, and CrowdStrike. You know, I've got some of the old familiar ones, Chipotle Mexican Grill, but a lot of the companies in my list are companies that I'd never heard of until this year. And looking at these, not only when I look at these chart breakouts, does it give me an insight to what's happening at that particular company, but I start to see patterns. And one of the patterns I am starting to see is healthcare. We have been told for years and years that technology and artificial intelligence is going to transform healthcare. And I've never really seen this reflected in the stock market. Well, I am seeing it now. I am starting to see dramatic price action across the field of healthcare. And this is so marked that I've dropped my rule about not investing in small biopharma shares. I'm now, if they've got a really good chart, I'm ready to have a go even with those, although I'm still prefer the ones supplying the tools, if you like, rather than the ones looking for gold. But the fact is that if a biopharma, a small biopharma, develops a new drug, the transformative effect on the value of that company will be staggering. So you only need one of those. So I have become more interested in placing some bets in that area. And I've got more healthcare shares in my portfolio now than I've had probably forever. And I'm also noticing that even big guys, AstraZeneca shares are hitting new highs. And I've just found a Japanese share, which is in partnership with AstraZeneca on a very, very exciting new drug. And their shares are going through the roof. And I've also found in weird areas that you wouldn't expect, electricity shares in the States are going ballistic. And they're going ballistic because of AI, because everything that's happening with AI means this gigantic build out of data centers. And this gigantic build out of data centers is having a dramatic effect on electricity demand. Oh, you know, it just goes on and on. It's fantastic. And oh, there's so many. I mean, railway companies in the States. There's a company that builds locomotives. Who would have thought in 2024 that would be an exciting business? Well, it is. So I've completely opened my mind. You know, at the start of this year, I thought it's all about AI. I don't think that anymore. AI is very, very exciting, but the whole thing is now spreading dramatically into other areas of the stock market. And also, people will have noticed I'm doing a lot with fast food companies. And again, this is all coming out of my new approach using explosive chart breakouts. Because every day I'm finding new names, and then I do my usual thing. When I find a couple of new names in a sector, I start go off and look at the whole sector. I start looking at what the ETFs are doing in the sector, who's in the ETFs, and it's a rolling process. But it's all now very heavily based on this explosive chart breakouts technique, which has become a real game changer to my approach. And I'm already, as I did when I first started investing, I'm already starting to spend the money, taking a close eye at which color Aston Martin I'm going to buy and stuff like that.
Oh my gosh. Okay. So Danny, I'm conscious because it's 1:30 and we just have to let enough time to do the questions. So you can choose perhaps. Either you can talk about the Zen and the art of stock selection, or you can share a personal anecdote, either on a big win or
let's quickly hit both of those. Zen and the art of stock selection. I've spoken about this in the past. When I was, I don't know, just come out of university and full of nonsensical ideas, I read a book called Zen and the Art of Motorcycle Maintenance by a guy called Robert Persig. And it had a fantastic influence on me. He basically said that whatever you're involved with, in his case, fixing motorcycles, it always turns out that whatever it says in the handbook, there's always some problem, some damn nut that is just fixed solid or something that's wrong that you have to deal with. And the handbook's not got any ideas about how to do that. And you just have to figure it out from experience, from luck, whatever. Ancient law. And so he became convinced that everything was like that. And I thought, well, this applies amazingly to the stock market. The stock market is a world of journalists and analysts and columnists and people who are looking at shares and trying to make sense of it all. And particularly the analysts try to make sense of it in terms of numbers. And as a result, the analysts almost never get it because it isn't all about numbers. And it's the important thing, the bit that they can't quantify, which is the bit that really matters. I don't know a thing about how NVIDIA does what it does. I barely know what a GPU is. I never play computer games. And I have only the vaguest idea of what a data center is and how it uses their chips. Yeah, okay, it's a place full of computer servers running in parallel. But beyond that, if I was walking around with one of the guys running it, I'm sure he'd tell me a million things and I'd be absolutely stunned. Oh, I didn't know that, didn't know that, didn't know that. But it doesn't matter. What I'm really trying to do is find out if I get this kind of buzz from NVIDIA and any other share like it, which really tells me I can almost tell, it's probably an analogy that my daughter will disapprove of wildly, but it's almost like when you see a girl in the street and gosh, really like her, goodness. And it's the same with shares. And it won't be the same for everybody. Other people look at the same girl and think, gosh, what's the big deal? And shares are the same. I know which shares work for me, and that's why I can very quickly tell you which are my kind of shares. And so to fill a portfolio with those shares makes a lot of sense. And filling the portfolio with it is more relaxing, and it's the Zen bit. It's this bit you can't quantify. It's the magic, and it's, I don't know. If you listen to Jensen Wang delivering a lecture, you just God, NVIDIA is an incredible business because this man has a soaring imagination. He's just amazing. He's just such a staggering human being. How could anyone not want to back this guy to the hill? Because he's just outrageously talented and creative individual. And America is full of companies like that. they really go for it. Sorry, what was the other one? Oh,
Okay,
anecdotes.
so
Yeah.
yeah,
Oh God.
exactly.
I mean, I've got millions
And
of
honestly,
those.
you have a few minutes to answer this because we
Okay,
will run
okay.
out
Well,
of time.
in recent times, my three biggest winners and losers have been Supermicro Computer, MicroStrategy, and IC Zoom. I mean, Jesus, the roller coaster ride. I couldn't believe it that it's happened 3 times in a row. I made an absolute fortune almost overnight with Supermicro. I then went off that and made an absolute fortune. I mean, game-changing amounts of money on MicroStrategy, and then lost it all. And then made an absolute fortune with IC Zoom, and then that reversed and wiped me out in a day. So absolutely, I mean, the IC Zoom one was a real hit. Gosh, I had to. I mean, normally I just take these in my stride, but that one, crikey! I mean, from $60 to $6 in a day. Who ever heard of a performance like that? I left poor old IG with they had to absorb a loss of £90,000. It's
Oh my
incredible.
God.
I'd be so embarrassed I haven't dared to ring them up, having given them such a bloody nose. But I mean, thank God I was trading it in a separate account. I mean, that's absolutely a message. If you've got a very speculative share in your portfolio, you either make sure it's only a small proportion of the whole portfolio, or if it starts to get very big, it's best to put it in a separate account so that if it does do a complete wipeout like that, it doesn't bring everything else down, which is what happened to me. So I came out of it. You might have thought after a disaster like that, I'd be sort of homeless, but no, it was just a hit.
Okay, well, thank you. If you have got a minute,
I just do want to emphasize this thing about the explosive chart breakouts. That basically, I am going to feed out to you on pretty much a daily basis. I think I need to find a way of doing it more quickly because otherwise it's hard to cope with the numbers. But I'm going to try and keep you up to date. And we are even considering, and I don't think I'm giving anything away here, but we are even considering actually publishing this a list of the sort of favored names, Quentinvest names, which will be continually added to by these explosive chart breakouts, so that to make it much easier for you to benchmark whatever you're doing against what we think is a good thing to do. So we're thinking about that and how to do it. We're also looking into ways of automating the list, automatic updating, maybe automating the behavior of the moving averages and all those things to really make it, add artificial intelligence to what we're doing like everybody else is. But I do think that this is this using these explosive chart breakouts is a real opportunity to make money, even if you do it without the leverage. I do it with the leverage, and the other thing I do, which I'll look at in probably in a future webinar, but this is what I call leaders and laggards. I am continually switching my portfolio from laggards into leaders, and so literally. I don't like red ink, and I don't tolerate it for very long on my portfolio. What I like to see is I like to look down my portfolio and see a sea of blue. And there is a tendency over time for this to lead to concentration in the better performers. I don't mind that. I like that. I think that's a good thing. And because I use leverage, this whole thing can, with a good market, it can move ahead very strongly. I think the reason why the market isn't moving ahead very strongly, incidentally, at the moment, why it keeps on sort of starting off and then falling back, is because the bond markets are still bond yields are still staying up there around 4.5%. And that is, everybody's hoping these bond yields are going to come down. Well, it hasn't happened yet, and the American economy stays so strong that nobody knows when it is going to happen. And I think that's one of the reasons. It's like the stock market's going along, dragging an anchor behind it.
Okay, well, thank you very, very, very much. All super interesting and very exciting. So I'm going to, let's try and answer as many of these as possible. We might still run over, but obviously if you have to go at 2 o'clock, then please do. And thank you so much again for joining. Okay, so Graham, my question for Friday. In the QL days, you used to tell us when to sell, and that is always helpful. Is there any chance that you can do that going forward?
Right. Well, I need to qualify that bit. It wasn't that I told you when to sell. I operated a stop loss system, and I have come to lose faith in that stop loss system. We live in a world of day traders, momentum investors, the incredible availability of information, the focus on growth shares. I mean, value, the sort of Benjamin Graham concept of value is pretty much died a death, I think. I don't think there's many value investors out there. And the ones that are, just look at this stock market, they just can't believe it. They just think the values are so high, they can't engage with it at all. So a 20% fall in a share is no longer a compelling reason for selling. So what I prefer, my preferred selling technique is this leaders and laggards approach. If you've got a share in your list, portfolio list, that the weeks and months pass and it stays in the red, or if it goes into the blue and then goes back into the red, I don't like that. I'm inclined to switch out of it. The thing for me is it's part of an ongoing relationship, because if that share then goes back into the blue, a recent example for me is Alarum Technologies, which is got a business called NetNut, which is increasingly dominating what happens at Alarum Technologies, and NetNut is growing incredibly fast. And I think Alarum Technologies has got a lot of potential. I really like that one. Well, I got so fed up with the way it just wouldn't go up that I sold it. And then, of course, they reported results, probably went up about 30% on the day. And I realized that I should have stuck with it. So I've now bought them back. And of course, as I think many subscribers have noticed, one of the problems with chasing explosive chart breakouts, and it's been a problem for me all my investing life, is that you're buying a share that's just gone up 20 or 30%. Of course, the next thing it does is to go down. So I am very used to the idea that I buy a share and the very next thing it does is go down. And to a large extent, I disregard that, because I'm buying the breakout, I'm buying the fundamentals, I'm buying the latest news from the company, I'm buying the prospects for the business, and I'm pretty confident that once that profit taking has worn itself out, and the day traders have come out, and the momentum guys have closed their positions, that it will then start going up again, and we'll do all the things that I hoped it would do in the first place. But I don't mind going into a share, coming out, going in, coming out, going in. I'd probably do a lot better if I just stuck to my guns. And actually, I would advise most of you, be patient, unless it really starts to become a laggard. But in a big portfolio, it doesn't matter, because if you've got 100 shares in your portfolio, as long as a lot of them are doing well, a few of them can do very badly. And in fact, another example that I had, and this is one that hasn't even been written about yet in Quentinvest, it's a company called AZZ. God, I remind myself, what do they do? It sounds very silly. I can't remember what they do, but they do some kind of nuts and bolts thing, but they're doing it very, very well. I bought shares in them after they had jumped. They've got a fantastic chart. Chart is amazing, huge breakout, really explosive. And as I said, everything about them is 3G. So I bought the shares. and they promptly announced a massive fundraising, and the shares fell sharply because what often happens when companies announce a big fundraising is that these crafty institutions that have a big stake, knowing that they're going to get shares in the placing, they take profits on the shares they've already got. So you get a whole lot of technical selling pressure, which forces the price back towards the whatever the strike price is for the issue. And I thought, yeah, I know, that's exactly what's happening. So I did the obvious thing and I bought some more. I averaged down because I thought this is a classic example. I think they were in 78 or something. They fell all the way back to something like 71. I bought some more, lowered my average cost, and then I got fed up with them. They stayed in the red. There was something else I wanted to buy, and I thought, oh, what to hell with them. So I sold them, and I was going through looking at looking for explosive chart breakouts, and lo and behold, there's AZZ. They're now $84. My analysis of the situation was exactly right. I did exactly what was the smart thing to do, but then I simply didn't stick to my guns as I should have done. So now I've ended buying them back at $84. Ridiculous. What a stupid thing to do. But there you are. Hopefully they will now deliver on the promise of that amazing chart breakout. It's very, very powerful. I mean, you know, they could easily go to $200 or something. Gosh, they look amazing. So you know, this is why I keep on saying, do what I say, not do what I do. Find your own way of using the information, because I'm sure you'll do it much more cleverly than me. I'm ridiculous at the way I actually operate.
Okay, thank you, Teddy. So some of the questions that I'm reading, you've sort of answered already, but I will read them out because people have taken the time to submit them. So Shabir says, when a share has an explosive chart breakout, is it normally a long-term uptrend, or do we put a stop loss, take short-term profits and get out? I worry buying at the higher end of the breakout and then get a retraction. Appreciate your view on this.
Yeah, well, I have more or less answered that. One thing I never use is stop losses. I absolutely don't touch them with a barge pole. I not only do I not like stop losses, but they have an incredible ability to take you out and then the shares go up. It's much better to just keep an eye on your portfolio and decide what to do, and try and apply more patience than I do. I mean, really, at the end of the day, you could say to yourself, if the chart looks good and the fundamentals are absolutely unchanged in looking good, why on earth would you want to sell them? I'm continually selling shares, which I would say to anyone who asked me, yeah, that's a terrific investment. So why are you selling them? Good question.
Okay. Now, next one, Barnett. Looking forward to your webinar tomorrow. I'd like to inquire about your strategy. Do you believe it's more sensible to buy on margin rather than purchasing leverage shares?
Not quite sure what the difference is. I mean, leverage shares, there are some shares with built-in leverage. I think you can buy a sort of Tesla times 3 as a share. I never do that. If I want leverage on buying Tesla shares, I'll just buy them. I mean, in practice, I only do spread betting now. I would make a spread bet on them with 5 times leverage. So they're now starting to introduce shares with 5 times leverage and ETFs with 5 times leverage. The only advantage of those is if you're really confident in the performance, as I am with, say, QQQ3, the leveraged bet on the NASDAQ 100, which I have got some of those in a share account. Yeah, you know, QQQ times 5, why not? Because it's in a share account, you can't be forced to sell. And you can always, if they tumble, you can buy more the beauty of those ETFs, those leveraged ETFs, is they're going to recover. Of course they are, unless the American economy suddenly just completely implodes. And there's not only is there no sign of that, but it seems to be getting stronger and stronger. In fact, as I think I've mentioned in one or two of the alerts, there is this theory going around, incredibly exciting theory, that generative AI is going to be so powerful that it is going to start to impact on global productivity and the rate of economic growth worldwide. And I've seen the suggestion that the world economy as a whole could start growing as fast as China was in its glory years, by sort of 8% a year. I mean, God, if that started to happen, you wouldn't see these stock markets for dust. That would be absolutely amazing. And I can see the case. Why not? Why shouldn't that happen? Generative AI, I mean, we don't know what it's going to do, but I mean, what we can see is that trillions of dollars are being spent on upgrading the world's data processing capability. What we don't know is what effect that's going to happen, but it's going to have some amazing effects. That's why with the healthcare shares, I'm starting to think, God, that's going to have an amazing effect on healthcare. It's going to have an amazing effect on everything, and it could have an amazing effect on global growth. I can easily believe that.
This is a great conduit into the next question, submitted by Peter. My portfolio is populated almost exclusively with AI stocks. How long do you think that the market's infatuation with AI will last? To what extent do you think I should diversify into other areas, given the fact that with no new money available to me, I would need to sell stocks like Nvidia to achieve this?
Well, I don't think you should sell your AI stocks. Certainly not. Why sell Nvidia? Greatest company in the world, greatest company of all time. Why sell them? I'm sure Jensen Huang's not going to. I think I mean, just reading those latest results from Nvidia, there is not the slightest chink in the armor of that business. It is absolutely firing on all cylinders. It continues to be the most amazing company of all time. It's just absolutely got it. And there's obviously companies that are swirling around that. I'm starting to get increasingly interested in Dell Technologies. Michael Dell is a very formidable guy, and he's the CEO of Dell Technologies. And I haven't fully grasped yet what Dell Technologies is doing, but I think they've got the world's biggest sales force, and they are leading the sort of application of AI to desktops. I don't know. I know it'd be silly for me to say I understand what they're doing, but I'm getting a very good feeling about Dell Technologies. I've got an amazing chart. I know the guy is amazing. I mean, he transformed the whole desktop computer. He's the reason why we entered this phase where there was a desktop on every desk. In a way, Michael Dell was the reason why Microsoft did so well, because they supplied the software and he was getting these machines out there. And unbelievable, everybody had a Dell for a while. It just took over business. So, I can see Dell Technologies being a very, very exciting stock, and it's now part of my quartet. It's Nvidia, Supermicro, Vertiv, which is rather similar to Supermicro, I think, and Dell Technologies. And I probably will add to that. But if you're only in AI and the world is in the greatest is at the dawn of the generative AI era, that cannot be a bad place to be. So, the other thing I was going to say, though, is, and you probably won't want to do this, and I think you'd be wise not to, but if you held those shares in a spread betting account, you would, of course, their rise in value would generate funds which you could use to invest in other shares. But obviously, what you're then in doing is introducing the risk of losing your AI shares if the market goes to a bad phase. So, but I think AI, yeah, terrific place to be. Nothing wrong with that.
Great. Thank you, Dad. And then from Robert, after the explosive growth in the first quarter of 2024, the market seemed to quieten down a little. I note there's been some growth of late with a fair bit of volatility. I see that you're recommending lots of smaller companies, but what are your thoughts on the Magnificent Five? And then obviously you've talked about, in particular, your beloved NVIDIA. Now, you've obviously spoken about NVIDIA, but perhaps you could talk about
there doesn't seem to be any sign of a loss of momentum in the great American growth shares. I mean, Meta Platforms had a setback, but I don't really think there's anything wrong with that one. Tesla, yeah, Tesla is looking very wobbly, and people are very worried about competition coming into the electric car market and plunging used car values. A bit annoying for me, really. I seem to be nursing a huge paper loss on my purchase of a electric car, but I don't mind. It's great. I love driving it, and I don't. I think Tesla is a work in progress still. It's going to change. I mean, I can well imagine that making electric cars is going to turn out to be a very competitive business and hard to make a huge amount of money out of. Although Ferrari seems to be doing very well, but then it's more like a luxury goods company. But car companies are obviously going to change into something else. They're going to change into transport as a service, all sorts of other things. Elon Musk and Tesla are very well placed to do that. And he, like all the Magnificent Seven, is doing something that nobody else in the world is really able to do, which is spend incredible amounts of money on NVIDIA chips. They're allowed to, unlike the Chinese, and they've got the money to do it. And I mean, the computing capacity that is being put together by these giant American technology companies is absolutely unreal. I mean, many, many years ago, I saw a film called 2001, and everything was decided by this computer called HAL on the spaceship. And these big tech companies are turning into HAL, and God knows where they're going to go with that. But nobody else can do what they're doing, and they've got the audience. I mean, just think of Meta Platforms. It's got half the planet engaging on a monthly basis, if not a daily basis, with what it's doing. That is a platform for rolling out new technology you just couldn't believe. So yeah, I don't have any big worries about the Magnificent Seven. I just wonder how big they're going to become. The more the worry, I suppose, might be political. But they've got America behind them because, yes, the Europeans, I'm sure, would like to take these companies apart. And the Chinese try to stop them coming into China and all those things. But the Americans won't want to do that. These companies are the spearhead of the American Revolution. Yeah, so I don't see the Americans backing down on them.
Okay, thank you, Dad. So we've got two more, and as I said, if anyone will answer these, and then we'll probably call it a day until our next webinar. But if anyone needs to go, then thank you so much for joining. So, Michael, what stop loss rules do you use, if any, on your spread vesting account for the explosive breakout shares? I know you mentioned this a bit earlier.
Yeah, I mean, the simple answer is none. Okay. What I do, as I've mentioned, my version of stop loss now is this leaders and laggards strategy, that I'm endlessly rotating my portfolio from red ink to blue ink, if you like, from losers to winners. And I'm not sure that I gain a huge amount from doing that. It just It's just that I probably, because I'm watching the stock market so much, I take a lot of decisions that I don't need to. If I could leave well alone, probably all work better in the end. It's amazing how many shares I sell, and I look back afterwards and oh, that was completely unnecessary. But of course, the good thing is that it does tend to focus my money on the winners. And I don't stop that from happening. I never resist that temptation. I mean, I've got several shares in my portfolio now, which are 5 times the value. The holding is 5 times the value of the newest entries. And that's always going to be happening. And that's just part of the way I run it.
Okay, thank you. And then final one from Tony. Hello, Quentin. The minimum 10% gap, is this on a daily chart?
Yes. Yeah. I mean, you could use sort of common sense. I mean, the example I gave of Microsoft, I based on a weekly chart, because the daily, I tried to do it on a daily chart, but it just completely disappeared on the chart. It's got a blank space, and I wasn't clever enough to get it back and find out. So I went back to the weekly chart. But generally speaking, yes, I'm looking at that on a daily basis. But then, having looked at the chart on a daily basis to find this explosive chart breakout, I will then look at it on a longer term basis, because it's with the longer term charts that I establish whether a chart is a CG, is a great story, great growth, great chart. Those great charts in that context are long-term charts, the longest term chart that is viable for the share. But the explosive chart breakouts are daily. Yeah, absolutely daily.
Great. Thank you. All right. Well, it's 3 minutes past 2, so I think we've done pretty well. And we've covered lots. We've managed to get through all the questions. So thank you to everyone who submitted the questions. Thank you to everyone for joining us. We will be hosting another one soon, probably in a month or 2. So we'll let you know about that. But we wish you a very, very nice and hopefully sunny bank holiday. I don't know, Dad.
Can I just say one thing?
Yeah,
I would welcome any feedback from anyone. It helps me a lot to hear how you're experiencing investing. How it's going for you, whether it's working, and mainly that, really. I like to think you're all being successful, and so any feedback on that front would be very helpful.
Great. All right. Thank you. Enjoy your weekend, and we'll see you next time. Bye.